stop. If you plan to invest in 2026 the same way you did during the easy money years, you are setting yourself up for serious losses. I'm James Harrington, and I've watched this cycle repeat itself again and again. I saw investors get wiped out during the dot-com bubble. I watched it happen again during the financial crisis of 2007-2008. And every single time, people believed the same thing. This time is different. It never is. The market environment heading into 2026 is shifting in a way most retail investors are not prepared for. High interest rates, expensive valuations, heavy corporate debt, and speculative behavior, especially around artificial intelligence, are colliding at the same time. That is not a healthy setup. When money is no longer free, mistakes are punished immediately, weak companies get exposed, overpriced stocks get crushed, and undisciplined investors pay the price. Let me explain why this matters so much. For years, capital was cheap. Companies could borrow easily, burn cash, promise future growth, and investors were willing to wait. When rates are near zero, future earnings look extremely valuable. But today, the cost of capital has changed. When interest rates rise, the present value of future earnings drops. That means stocks trading at 30, 40, even 60 times earnings are extremely vulnerable. Any slowdown, any earnings miss, any guidance cut, and the stock can fall 30 or 40% in weeks. That's not fear. That's math. So let's talk about the 5 critical mistakes investors are about to make in 2026. The first mistake is buying companies that don't generate real cash flow. If a business cannot produce consistent free cash flow and return capital to shareholders, you are not investing. You are speculating. In a high-rate environment, investors demand to be paid for risk. Dividends matter, income matters, cash flow matters. When markets pull back, dividend-paying companies provide a cushion. Non-profitable growth stocks do not. They rely entirely on optimism, and optimism disappears quickly when conditions tighten. The second mistake is ignoring valuation. I don't care how great a company is. If you overpay, you can lose money. I've seen incredible businesses lose 70 to 80% of their value simply because investors got carried away and paid unrealistic prices. Higher rates mean lower acceptable multiples. Period. If earnings growth slows while valuations remain stretched, multiple compression can destroy returns for years. Discipline means walking away when the numbers don't justify the price. The third mistake is confusing AI hype with profitability. Artificial intelligence is real. It's transformative. But most companies riding the AI wave will not become dominant long-term winners. Infrastructure is expensive. Talent is expensive. Computing power is expensive. If a company cannot translate AI excitement into sustainable margins and real free cash flow, it will struggle when enthusiasm fades. In every cycle, there is a theme that captures imagination. In 2000, it was the internet. Today, it's AI. A few companies will thrive. Many will disappoint. The key is focusing on economics, not excitement. The fourth mistake is overconcentration. Investors fall in love with a stock. It goes up. They add more. Soon, one position becomes 30 or even 50% of their portfolio. That is not confidence. That is risk blindness. No single idea deserves that level of exposure. Earnings can miss. Regulations can change. Competition can appear. When one position dominates your portfolio, you are one bad headline away from permanent damage. Diversification is not boring. It is survival. The fifth and most underestimated mistake is ignoring interest rates and debt. When rates rise, debt-heavy companies feel pressure immediately. Refinancing becomes more expensive. Interest expenses rise. Profit margins shrink. Share buybacks slow. Dividends get cut. Balance sheet strength becomes critical. In a high-rate world, leverage is unforgiving. Investors who ignore debt metrics will be shocked when earnings collapse under financial strain. Now let me tell you what I'm doing differently. First, I prioritize income-producing assets. I want businesses that generate strong free cash flow and return capital consistently. Dividends are not optional in this environment. They create discipline at the management level and provide stability at the portfolio level. Second, I focus on quality. That means strong balance sheets, predictable revenue, pricing power, and low leverage. Companies that can survive an economic slowdown without cutting dividends or issuing dilutive shares. Third, I respect valuation. I set strict entry criteria. If the price does not offer a margin of safety, I wait. Patience is a competitive advantage. Fourth, I diversify intentionally, across sectors, across asset types. No single position can threaten my financial future. My goal is not to hit home runs. My goal is consistent compounding. Fifth, I hold cash strategically. Cash is not trash in a high-rate environment. Cash provides optionality. When others are forced to sell during volatility, cash allows you to buy quality assets at attractive prices. Understand this clearly. 2026 is not about chasing trends. It is about protecting capital and positioning for long-term growth. Markets reward discipline when capital has a real cost. They punish arrogance. They punish speculation. They punish emotional decisions. You do not need to own every exciting stock. You do not need to follow every headline. You need a plan. You need risk management. You need to demand cash flow. And above all, you need to respect that interest rates change everything. If you internalize these principles, focus on income, respect valuation, control risk, avoid overconcentration, and prioritize balance sheet strength, you will not only survive 2026, you will put yourself in a position to compound wealth intelligently for decades. Remember this, the goal of investing is not excitement, it is endurance. The investors who are still standing after volatile cycles are the ones who understood that protecting capital comes first. In markets like the one ahead, discipline is your greatest asset. And if you approach 2026 with discipline instead of emotion, you won't just avoid costly mistakes. You'll be ready when real opportunities appear.